Hello and welcome everyone. Thank you so much for joining us for today's State of Freight webinar presented by Aurora. My name is Julia Becker. I'm the Vice President of Media Operations here at FreightWaves. And I am joined as always in our studio by our CEO and founder, Craig Fuller, and Head of Freight Market Intelligence, Zach Strickland. Today's conversation will cover the latest insights from SONAR, current market trends, and insights from our experts. Craig and Zach will also take your questions at the end of our webinar today, so remember you can enter those at any point. But before we get started, I want to cover just a couple of quick items. If you have any questions or issues during the webinar, you can reach out to me via that team chat function in your webinar console, and I'll be in touch to assist you. And those questions for Craig and Zach can go in your Q&A box. We'll save time for those questions at the end. I'll also send a link to the recording of this webinar tomorrow in case you want to watch it on demand or share it with your colleagues. And now I'll turn it over to Zach to kick us off. Zach, let's jump right in.
All right, thank you for that, Julia. And thank you to everyone who is tuning in this month's State of Freight. August, we're winding down the summer months. It may not feel like it's quite over, especially for myself. I'm in short sleeves today because I'm still sweating.
It's still hot. You've been out there, Zach.
It's still hot, but you know what? It's that time of year for freight. I think we get that Labor Day action going, and it's hurricane season. It's, we do tend to get some disruptive events in the September month and lately October. But I think for most of our viewership, this has been still a pretty quiet freight market. What do you think?
It's a very quiet freight market. I mean, it has not been the freight market that we hoped for.
Right.
That's the freight market we've got. What is the old saying? You go with the team you get, not the team you want. And I think that's sort of the way the freight market's worked. It has been incredibly soft. I think if you look at year-over-year volume numbers, we're down more than mid-double digits, like 14%.
Yeah, 14, 15% on the OTVI.
And that's a reflection of how soft the economy is. And I've talked to a lot of people that are in the goods economy. I've talked about just how soft things are. It's interesting. Visiting with a very large retailer last week, they've talked about how, they're doing well, but a lot of it's because the consumer staples is sort of holding up. Yeah. But when you get into like discretionary spending items, I think is where the big challenge is like consumers are definitely, I mean, if you're in, say, a big box retailer and you have grocery as core part of your portfolio, or you have like just normal goods, consumer staples, you're probably doing okay because particularly with people eating at home, they're not going out to eat. We see a lot of restaurant firms are failing. I think this is just a reflection of an economy that is definitely in some level of a recession. I talked to people who are not in freight are seeing it. And it's a weird thing because you look at what the Fed stance is right now with high interest rates. They've not reduced, and normally you would expect them to do. You also look at the stock market is still, even though we've had some rough, like the last week has been a bit rough, it's still doing quite strong. It just shows that there's a large level of just indecision that's taking place.
Yeah, I think we're still, a lot of the people I talk to in the shipping community, they're still dealing with some levels of uncertainty, not just from their procurement strategies for, the raw inputs and things in the goods economy, but also from their consumers and the downstream, because there's still some level of, we don't know where this economy's going.
Well, a lot of it is, so it's interesting because anybody who's involved in capital spending, so, and I'm talking about investment in infrastructure, real estate, investment overall, is just not happening. I mean, we are seeing manufacturing investment happen, but a lot of the dollars they're big. But a lot of those dollars are really related to data center or semiconductor.
Yeah, I saw a stat the other day from Apollo that basically showed how consumption from normal consumers is down, and data center investment is taking over a big chunk of it.
It's interesting because I believe commercial data centers have surpassed commercial real estate for the first time in history. And I think I've talked to people in real estate about data center cost. And what's interesting about it on a per acre basis, like if you go to Northern Virginia, which you have sort of the epicenter of data centers, particularly hyperscale data centers, it's like $5 million an acre for owning land. If you're like in East Tennessee, you're talking anywhere from $100,000 to $300,000 an acre if you can get clean power. And what's driving that is all the AI and the AI adjacent, these language learning models, which is driving a lot of that. And so the CapEx number looks massive.
Right.
But when you look at the stuff that moves freight, which is what we care about, semiconductors do not move truckload freight.
They're very small.
Yeah, they're very tiny, and they tend to move through highly secured transportation networks. They're not driving truckload volume. One of the things to keep in mind is we've seen the government pull back a lot of, there's been a lot of programs, government programs that have been canceled, put on hold. This has been part of Trump's core policy. One of the things that's coming from that is a lot of the money that people are spending, a lot of the money that drives the predominance of the freight market are in these high consumer consumption categories and demographics. And people that live typically in the government payroll, that took the lower end of that market, tend to be, there's this whole concept of velocity of money. How long does it take before I give you money before you spend it? Wealthy people will hold on to it, they'll invest it, they'll put it in an account. Poor people, or people that are sort of below the living paycheck to paycheck, will spend it as fast as possible.
Right.
And a lot of people who work in the government sector that have been laid off actually meet that definition. And we're not having a lot of the stimulus, so we're not seeing the pressure on the freight market. The other sort of two categories of spending or volume that you would expect to see is housing. Housing is in a really significant, and this is all real estate, but certainly housing is a real significant downturn. And auto is starting to get stressed. We were in Detroit. We had an offsite, a month ago or something, a couple weeks ago. And Chris Stallman, one of our board members, actually mentioned about how, there's just this signs of some of the auto market starting to restress.
The EV divestment.
Well, there's the whole, I don't know if there's been, I haven't seen, maybe there has been divestment, but there's been a restructuring of EVs. Like one of the core theses.
Maybe that's the right word for it, restructuring.
Yeah, I mean, one of the core theses of the Biden administration is that electric vehicles should replace internal combustion engines.
Right.
And a lot of the infrastructure bill, all these Build Back Better programs, and the Inflation Reduction Act, the core thesis of that was decarbonization.
Right.
And electrification of auto and power sector and all that stuff. That is no longer a core. It is obvious that has changed, right? And so the Trump administration is far more focused on of sort of moving back towards a multi-platform energy process, which, if you believe that decarbonization is a goal, a lot of people have problems with that. I think the Trump administration would argue that energy is life. It's actually, I believe it. And I think you need all forms of energy, and that's sort of the thesis. Should the government prop up electric vehicles? That's really a philosophical question.
Yeah, and probably not for this.
No, we're not here.
You're not going to get into that.
I have an electric vehicle. I have solar panels in my house. But I also recognize the need for other forms of energy. And like you said, it's not what we talk about here.
No, not here. But I think in terms of when we talk about autos and housing, these are the two sectors that really drive a lot of the freight.
These numbers are hard to come by because I would say a number that I would trust is approximately 20% of trucking freight is both directly and indirectly related to housing. The housing market broadly. Most people think of wood,
right,
and building materials.
It's not the building itself.
But if you talk to anyone who's ever in real estate or anyone who's sort of in the mortgage market, what they will tell you is the typical rule of thumb is 1 year of your mortgage payment is what you'll likely use to furnish your house. I think is the rule of thumb or something like that.
Somewhere in there.
And so if you buy a house that you're going to pay, I don't know, $30,000 a year on your mortgage, you're likely to spend that much money on furniture and finishings that you bring in your house. And so when you're not having a housing market that turns over, because remember, new homes is only a small percent of the overall housing market. A lot of it is actually in not second homes, but new to me homes, used homes, if you will. I don't know if the word used home is the right term.
Existing.
Existing, thank you, that's the term.
Yeah.
Used home is more for cars.
Right.
But the reality is those existing home sales drive so much, our pull through. Appliances are part of that, furniture is a part of that, carpet and floor covering is a part of that. And so there's so many other things that happen related to housing. When housing's down, the broader part. And our manufacturing sector is really a housing, a large percent of manufacturing in the United States is still housing based.
Right.
And when you have such a weak housing market, you're gonna have a weak freight market. And so it's hard to believe that a freight market would come back without the housing market there.
Yeah, let's talk about some of the data points here. The OTVI I mentioned earlier, let's pull that one up, because this is, I kind of want to lead with the bad news and get this out of the way quick, because this is the demand side of the trucking economy right now. Tender volumes, and don't worry, I think we've got a little bit of a twist, makes this positive here in a minute, but OTVI, this kind of deterioration has not been seen in a while. The fact that we're also on a down, like we've gone down below.
Normally we'd never expect July. August should not drop off. You have back to school. You've got this preparation. It definitely shows there's some economic stress. I mean, one of the crazy stats that I think, and you don't actually have it on here, is that current freight volumes are lower than 2019.
Yeah.
That is an insane stat when you think about the fact that we have lost so much ground in the freight market over the last 6 years.
Yeah, and so, I mean, I guess, and some of the people that I talked to, this next chart, let's get out of the OTVI sector, because you see that's down, doesn't look like it's getting much better right now, but the twist here is that it's not manifesting in the same way as 2019. With this next chart, outbound tender rejection index is actually up year over year, and it's significantly higher than it was in 2019, where we were hovering right under 4% at this point in 2019. And we even have a little bit of a jump here in the near term.
We definitely have a little bit of firming. Yeah. I think the question on OTRI is how much of it is, look, the freight market volume is really weak.
Yeah.
So it's definitely not a sign that the freight volume is firming up. And normally these are sort of run in tandem with one another. They haven't been running in tandem this year, largely because the capacity situation, so many trucks have come out of the market, and things are dramatically improving. So I think from where I sit, this is actually a pretty interesting market, because we're going to continue to see bankruptcies.
Yeah.
We're going to continue to see capacity leave the market. Volumes are continuing to struggle. There isn't a catalyst for higher volumes. And I think what we're seeing right now is just we're at a place where the market is in sort of a stasis. It's I love the term that you've used, which is it's almost like a heart arrhythmic monitor, where it just stays within a range.
Yeah.
We're sort of range bound right now on OTRI. And because it is fairly flat, it means that there's not a whole lot of interesting things. And I think shippers have to sort of, it's funny, you did I think it was with Echo, had sponsored a study earlier this year, coming into this year. Shippers were smarter at this game. It's funny because I've been around trucking my whole life. A lot of times you hear that shippers don't know what's going on.
Right.
This is sort of the thesis that truckload carrier executives tell themselves in their own groups. They don't know what's going on in the market. They actually were better at this. Their survey that Echo did, I think, had even better than my own, what we were looking at here and talking about. I clearly got it wrong about a recovery in the market. Was an incorrect assessment of the market. Clearly wrong about that. Not gonna say anything other than I was flat wrong. The reality is, though, that Echo, the survey of shippers, they didn't believe the market was firming or would firm this year. And they've turned out to be correct. Actually, are we doing a follow-up to that study?
I don't know. No,
we got to do it, Echo. Doug, call me.
Yeah, I was going to say, you have the contact.
We should do that.
Yeah.
Because I think getting a sense for where the market is, the shippers, and this is so contrary to what a lot of the truckload guys have sort of believed, is they actually have a really good sentiment for where things are headed.
And I think they were largely right because of the economic situation.
Well, I don't know that. Look, we don't do GDP stuff here at FreightWaves, and while we study and talk about GDP, it's usually such a weird disconnect. But I think a lot of the shippers probably saw structural weaknesses in the economy that were not apparent in the data, and it started playing out. I mean, we looked at it, looked really strong. Things were firming. They clearly have not firmed, and they sort of fallen apart.
But from a demand side perspective, it's
a demand side. Yeah. I think I don't know if I remember on this show but I certainly talked about it internally. I was at the airport a couple weeks ago. The CEO of a building materials company was there. The CFO was there. And this company's quite large in its sector, one of the largest. And the head of residential was also standing there, and I asked him how business was going. And they said different sectors are doing well, but they said the residential and housing market is really, really tough right now. And I said, we'll get back next year. They said, no, they think it's 27. And I said, because of high interest rates? They said, no, it's affordability. It's the houses, even if you reduce interest rates, the houses, because there hasn't been a lot of building, like new home building that meet the demographics, is there hasn't been enough, there's not enough inventory on the market. And you have these zoning laws in a lot of cities that and look, we are now past the post-COVID period,
Sure.
or COVID period when work from anywhere was sort of the norm. We've sort of gone back to people being in the office. I think one of the stats in New York City was that the daytime population in New York has now surpassed the pre-COVID levels, which is a sign that businesses are demanding. And look, it's obvious what sectors. It's finance. They want you in the office. It's like marketing and advertising. So creative functions, fashion. Those things are usually best. If you think about what New York does best, it's that type of business. And so it makes sense, but I think it's a sign that the work from anywhere experiment is largely done, and we're probably moving to I don't think we go back to where we were in terms of percentages, but I do think companies are now expecting employees to come in.
Yeah, I think too, I've seen some stats here about, there's obviously a huge bifurcation in the population about if you owned a house before COVID, you got a big inflation in your own equity. Like you now you have access to more cash.
Yep.
Because inflation of housing and housing values, and then you of course now have higher interest rate environment versus that. So there's two kind of headwinds there for anybody that didn't own a house.
Yep.
And then anybody that did have a house now has exposure to higher interest rates. They don't want to move.
Yeah.
And then economically, we've seen the jobs data, and I know there's a little noise around that, but there's clearly not a lot of movement in the economy from a labor perspective. Like people are not changing jobs.
Well, they're afraid to, and rightfully so. Look, this has been a really challenging year. I think much more so than most businesses executives thought about. And I think, we have had our own set of layoffs this year. Companies, it's been pretty consistent across the board that layoffs are pretty common. And I think because of the lack, I've read the JOLTS thing that the Fed puts out, which is job opening, labor or something. I can't remember what the whole JOLT stands for, but it's the labor survey.
Right.
Basically job listings, right? Yep.
Job openings and listed hires, basically job openings and hirings and
So the JOLTS is sort of an index showing sort of the strength of because the theory is that if an economy is growing, companies are adding people. If the economy is contracting, the companies are subtracting people. And I think what's happening is that there's just so much economic strife right now that companies are pulling back on investments. I know, like in my own businesses, this year is a cleanup year. I came in incredibly bullish, and we started really in March, like structural softness in our business, and the second quarter was a disaster, like absolutely utter disaster, because we had we missed incredibly in April and May our expectations. And so we've spent the last 3 months just playing cleanup. Let's take the time to basically restructure every piece of the business and fix the problems that we didn't have time to fix before. And that's what we've done. And I think I've talked to a lot of other CEOs, and that's what they're doing. Because when you can't focus on growth and you can't invest in growing a business, you end up saying, well, what can I fix? And there's this whole business theory. Ryan Peterson posted a book a couple of months ago about the book, and it was, I think it was like 40 ways to improve profitability or something. And the whole author goes into this whole conversation. It's a really easy book to read because the chapters are like a page long, which is my kind of book. But it goes into this whole conversation about, as a business owner or a business executive, you really only have two goals. Or you have, when you walk in the morning, drive revenue or cut cost. That's it.
Right.
That's all you are focused on as the chief executive officer of a company. And it's interesting because you can't, in this climate, drive revenue because the revenue just aren't there. The availability of revenue opportunities just aren't available to you. But what is available to you is to look at your business and saying, am I operating as efficient as possible? And that's what I've been forced to do. And I think a lot of executives that I've spoken with, that's exactly what they're doing. Is companies are now looking at their business and saying, we have grown, we've focused on all these things, we've done a lot of projects. Let's take a step back on those things. Let's take a look at it. Now, when you do that at one company, it's not impactful to the economy. You do it even in one sector, it's not impactful to the economy. When you do it across the entire economy, it's massively impactful. And that's what I think is happening, is that that's why the job market is soft, because no company wants to hire people. I think a lot of company executives are like have had struggles holding on to the people they had because they don't have the kind of work they had before. And right now it's a unit economic game, and that's really what's challenged. And there's so much uncertainty. Private equity also isn't making investments because they don't know how to, their models don't work.
No.
There's very little M&A because companies don't even know how to model the future. And this is what's causing incredible economic strife. Right
Yeah, I mean, all the earnings reports that I read through, 90% of them that beat. I mean, there were a lot of positive beats, but they were all driven by cost.
They're beating on the earnings side, not on revenue.
Yeah.
And, you know, it's because they didn't make the investments in human capital or in CapEx in January or even earlier this year. Some of it was they're waiting on some of the tax cuts stuff. But then when they got into the second quarter and we had Doge and we had Liberation Day tariffs and we had all this noise.
We had Mexico and Canada, which
all of
a lot of that
noise
stuff
created an enormous amount of
confusion.
Like, confusion, I think is the right term. And so companies just said, you know, CEO just said, I don't know. And I do think there was a period of time, some of the larger public companies that are actually really good at this probably responded in kind to that, where they just basically said, we're not adding these projects. I think smaller businesses, including my own, it took longer for us to sort of address, like we don't have the gluts of things, and it took longer for us to address it. And it really wasn't until July before I felt like we were in a good spot. I mean, it's been a really rough year. I'm not here to whine about business stuff. But
well, let's turn it into a little bit of a positive, because I think if we pull up the tender rejection index again, I think why the tender rejection index is actually winning is because of everything you just said. Everybody's been cutting, and that includes the truckload carriers and the capacity and the market, which is allowing this figure to stay elevated because they are managing the available capacity.
Well, there's a significant reduction in capacity. And in that significant reduction in capacity, what's happening is the market is resetting. At some point, this market is going to get to the point where there's enough capacity out of it. One of two things will happen. We either remove enough capacity out of the market where it goes, and clearly we're there, we're close to that number. And that's the reason that the OTRI number is pretty stable. But at some point, all of that comes out of the market. And the next piece of it is that volumes say, I don't think, yes, the economy can continue to contract, and it very well may be. I got to be completely frank. This market has humbled me in ways that I had no idea would humble me. Like, I thought having the power of data would give us some sense of it, but freight has a way of humbling you. And as much as I love the data we do, it is the most frustrating market I've ever seen. And I'm not alone in this. We need a support group, because every executive I talked to who had a thesis on the market has said nobody knows. And you and I do this show once a month, and we talk about what we think's happening, interpreting the data. This is so humbling because you realize you don't have a clue what's actually happening.
I mean, there's so much going on economically. I don't think anybody starting the year said that they called this year exactly right.
It would be impossible. And you look at the stock market on the sectors, a lot of it was early in the year was a rotation into sort of mid-market caps, as well as industrials for reindustrialization. That thesis fell apart really quick. Obviously, AI, you know, and you see this. You see sector. Anytime there's a movement from one like thesis to the other, whenever people have a lot of uncertainty about the economy, they actually move into these high growth sectors like AI, simply because it's like, hey, I don't know where the economy is heading. I can't predict how Procter & Gamble is going to do. Maybe that's a bad example because it's a consumer staple. But like the appliance manufacturers or the traditional manufacturer, I can't predict that. But I sure as hell can know that AI at some point in the next decade is going to be a high growth industry, and therefore, let's put my money in here because at least I'll get the benefit of growth, and that's what's created that bubble. Now, did we ever live up to reality? I mean, what do they say? Market can stay a lot more irrational than you can stay solvent. That's exactly what that looks like.
Yeah, so you saw at the end of the tender rejection index there, this little jump. Now, a narrative that I've kind of held on to here, I think because we're seeing this reduction in capacity, these carrier networks are getting thinner. That's just the fact. And the demand is allowing that to kind of stay under the radar a little bit. So here's a mechanism that I want to pull up in this map. Now, this is a map of the weighted rejection index. Don't worry about the technicality of what it means, but know that anything in blue, that's the most significant increasing rejection rates in the market based on volume and rate of change in rejection, and is in blue. And then the oranges are the most significant declines in rejection rate based on volume and rate of change. And you can see that Ontario, over there in Southern California, that includes the Inland Empire, is now dark blue. And then Atlanta over there in Georgia is now orange. Now, you're a trucker through and through.
I was one.
Yeah, this signals to me that there's a little bit of rebalancing in carrier networks going on, because earlier this year, just a month and a half ago, Atlanta led the way. It would have been blue on this map because it had a pretty strong.
And that whole blue to blue concept. By the way, I want to do a shout out to our app, the Blue to Blue app. It's you if you're looking for the lowest price access to SONAR data, it's $9.99 a month. We've never offered it out to consumers to get access to the rate data, but basically $9.99 a month, you can have SONAR's data.
SONAR data.
Pricing data is online. Go get it. There's a lane analysis. There's also one of the cool things, it was based on the Apple stock ticker app. So you see you can add OTRI in there. And what's great about it is I can log into it on my phone and never have to actually log into Core SONAR. Now, we hope that people continue to keep Core SONAR because we got to keep the lights on.
Right.
But it's also a great way if you're a driver and you're looking for something to rate, just rate index and get another form of truth. It's real cheap. It's $10 a month inside of the App Store. Thanks for teeing that up.
Yeah.
And the whole thesis of Blue to Blue is you run in the blue market.
Right.
Red is obviously a bad market, as you said. It's sort of a restructuring. I mean, a lot of what happens in Atlanta is that building. I mean, Atlanta, if there's a housing market, manufacturing city, a lot of cities have personalities. Houston is oil and gas, right? That is such a big market in Houston where a lot of the manufacturing is directly and indirectly tied to oil and gas. You go out to the Midwest, a lot of that is sort of ag and agriculture related. But Atlanta has a lot to do with the housing market because there's a lot of companies that are in the material sector that happen to encompass that Atlanta market. Detroit's obviously an auto. That is a lot what Atlanta's telling me, is that the Atlanta market is soft largely because of the really challenging housing market. Because you think about it, like furniture in North Carolina is huge, building, but there's a lot of, Georgia Pacific, one of the largest housing companies.
But do you not think that there's a little bit of like carriers are now saying, you know what, we spent too much time on the West Coast. I need to get my trucks back east a little bit, since that has been largely taken on.
It's also, there's a lot of reasons Atlanta has this, does, when markets are hard, trucks do sort of come into Atlanta because it's like, go to Atlanta because that you're more likely to get freight. And I think it's just carriers are responding to it. Atlanta, I think in most carrier maps, unless a company is strictly state driven, like say Texas or West Coast only, most companies that operate on the East Coast would consider Atlanta, Chicago, Allentown, Pennsylvania, running in that triangle. And Atlanta, some companies will not go as far as Texas, but they will go Atlanta, Chicago, Atlanta, Allentown. And so because of that, you may end up having sort of a parking lot of capacity that ends up there.
Yeah, a little power lane action in that triangle. And, the West Coast has largely been taking on intermodal volumes and intermodal's really taken a lot of share from truckload this year. Shippers, of course, having increasing amounts of time because they're pulling their freight forward into these warehouses, and they're staging them for longer than they used to because they have more time, which gives them the ability to kind of like take their time moving it across the country. And I think we're getting into this period, like normally September's really replenishment season. It's when we have intermodal peak. A lot of the long haul freight, it starts to trickle into the truckload market in October, November. And of course the November and holiday season is like, that's when we call it peak season for truckload, because that's when intermodal loses utility because people are like, well, it's got to move because their demand is there. What do you think is going to happen here as we start to see, we've had a pull forward environment. Some of this freight is probably already where it needs to be.
I mean, imports are collapsing. Like in recent days, let's pull up the import map, because I think this is a pretty telling factor, is that imports have significantly contracted. And the contraction is largely because the market has cooled off. And in doing so, it has really slowed down a lot of the other. I mean, at the end of the day, the import market was incredibly strong, in spite of the rest of the freight market being soft.
Right.
And it was interesting because you almost had the tale of two markets.
Right.
And now what we're seeing is the import market is soft at a time when core trucking continues to soften.
Right.
And it will be interesting to see what happens in the third quarter as we move further into the third quarter and into the peak season starts in October, because the question will be how much inventory is actually here versus, and so we'll find that out when we get into the number. I think we might have a decent fourth quarter just because there's so much product. Companies don't like to end the year with a lot of excess inventory. So they may very well liquidate, but I do think if you're in the ocean, it's just going to be a pretty tough market.
I think that they're keeping their inventories a little tighter because they're worried about overhang. Yeah.
It's the uncertainty element. And this is just like hiring people, is like when you don't know where things are headed, your natural inclination is to do nothing.
Right.
And once you sort of resolve that things might get worse, you then resolve yourself to actually shrinking, whether we're talking human capital or investments. You start basically delevering your entire business. That is a normal, rational business practice. And that's what I think businesses have been doing for the last couple of quarters, or certainly for the last 2 quarters, and that's why earnings look so great, because they're generating a lot of revenues, and yet their costs are being turned out. And what they're actually doing is they're sacrificing growth in the future by cutting back. If these employees and these capital investments were truly productive, then when I stop making them, I'm actually sacrificing future growth, if that's real.
Right.
I don't know. A lot of times it's just, it may not be as productive as they hope it is. But I think what they're also communicating is they don't have a lot of confidence in the future. Therefore, they're not holding on to resources that they need.
Yeah, I think a few of them I've talked to myself have been saying, I don't have it up on the IOTI chart, but there was a big overhang in 2022 where they over-ordered.
Yep.
Complete opposite of, what we saw earlier in the pandemic where they were worried about not having enough.
I think in 22 is a little different than what we see now. And this is much more orderly.
Right.
And in 22, it was a panic of, I don't have anything. If you remember, there was periods of time. By the way, if you bought anything during that COVID period, it's probably breaking right now. I mean, I built a house, or onto my house, during COVID, and there have been so many things, appliances and like fixtures and faucet stuff, that have just broken. And a lot of what happened is that companies were in such a panic because their supply chains were so messed up that they ended up using a lot of replacement parts that they weren't skilled to use, or were not as good as the ones that they had been. And maybe in some cases they were just as good, but they didn't component them right. It wasn't as fit. And so you see a lot of, I've had a bunch of warranty claims on a lot of appliances that I bought for my house. And it's largely because I think these COVID products were used as fillers during this weak market. And I think that's what we're dealing with.
Well, we should see a resurge in shipments now if we're going to get these replacement parts coming through, right?
No. I think a lot of what's driven this is not, a lot of what we're seeing right now and what we've seen over the last year is a lot of it's big box retailers that have been driving the predominance of the build up. I do think there was probably a short term, go back to this chart real quick. There was a short-term surge that happened from May to really the end of June or early July of just companies trying to get all the shipments that are put on hold.
Right.
And if you look at the crevice or the hole, the canyon, and then you look at the mountain, you always put those together. It's a pretty telling market that is kind of flat.
Yeah.
But it's starting to slow down a lot. And I think that is a worrying sign for the rest of freight, because it means that companies don't have a lot of confidence in the fourth quarter.
Yeah, and here's a chart that I write about this chart often in the Daily Watch, just because I think it's so fascinating to look at the short haul versus long haul market for trucking. I think some of the carriers clearly see this reflected in their data as well, that trucking has become a short haul game.
Yeah.
They've lost this transcontinental market significantly. And I think this will be an important chart to look at here in a month or two. Does trucking gain that LOTVI, which is loads moving more than 800 miles, COTVI is moving less than 100 miles. And they've become this like short haul. I mean, they don't have fungibility with the intermodal and rail networks at that length. The costs also don't become quite as divergent, but that long haul jump there at the end is a little, we saw the Ontario market be part of this. If long haul volumes start to come back in a more fragile freight market, I think there is a chance that this is maybe a surprising peak season. I don't know that there's anything behind it.
It's possible. It is quite possible. I think largely because of the inventory build.
Right.
I think, the tax bill was good potentially, but even the bonus depreciation number that I think a lot of people were super excited about. I was at an air show earlier this year, or in July, at Oshkosh, which is like the big air show. And I was talking to some of the aircraft dealers, and I said, gosh, you guys must be super excited and pumped about the state of the aircraft market. And they said, not really. And I was expecting to talk about bonus depreciation being a huge driver. And they said, there's so much uncertainty right now that nobody wants to make big CapEx spending. It's like nobody wants to go buy an airplane, as an example, when they don't have confidence of where the market's going to head. I mean, that's a very expensive purchase. It's also a big drain of resources in some ways. And so I think all of that is sort of telling on where things are at. And I think this is ultimately what we're dealing with, just a lack of certainty in the economy.
Yeah, I think, I was talking to several financial services sector people about when the big beautiful bill passed, and they were very bullish on it. And I tempered them, and I was like, guys, the stuff that I've heard from most of the shipping community has been very cautious. Like a lot of the depreciation would make sense. It made sense in 2017 because there was nothing in their way at that point. There was nothing holding them back. This is a different environment in the sense that they don't like. If you were investing, and I'm just going to use supply chain as an example because that's what we do. If you were thinking about China Plus One strategy for the last couple of years, and you're thinking, I'm going to put a factory in India, that's going to be where I go. Boom, there's a 50% tariff on it all of a sudden, and I could not foresee that happening.
That's the problem. And while I remember back last year when I was supportive of Donald Trump's administration, his victory, publicly, talking about, I think, reindustrialization is a positive thing, and we talked about it a lot of the show. I was excited because I was like, this is the opportunity to secure supply chains domestically, and we'll have a really solid policy of that. What I didn't expect, and people who, and I'm going to get blown up on Reddit again, people that sort of said, you get what you deserve is going to be the funny part, because yes, if you sort of look at the inconsistencies, I agree with these people. I think the problem is this uncertainty coming from the administration, and the Federal Reserve has done nothing to help.
Right.
Like they haven't reduced interest rates. Now people argue that they're not responsible for the 10-year, and we'll put that aside for a second. But the fact remains that this uncertainty and this lack of relief is causing so much of the economy to slow down, and that is certainly being felt in the freight market. And until we have some direction. And it may be another 3 years or two, however long we have, I guess 3 years, 3.5 years before we actually see some direction. I think that would be a real challenging market. Now, at some point, capacity moves. Even companies that aren't adding trucks, those trucks are getting old now. Maintenance is going to add up. We saw Carol Fulmer file bankruptcy, probably the biggest bankruptcy from a name that we had all year.
Right. A little under the radar.
It wasn't under the radar for people who have been in trucking a long time. It was under the radar for a lot of people. But certainly not under the radar for people who've been in trucking a long time. And that bankruptcy, I think, is certainly probably the biggest story so far this year in terms of trucking bankruptcies. But there will be more.
Right.
It could be a big one coming. I'm not going to speculate on who that is. Other people can do that. But I think there'll be a big one. By the way, when I say that, people are like, oh, Knight Swift's next. I'm like, no, I'm not talking about
doing
big,
just fine.
big public companies.
Right.
Someone's like, US Express is in trouble. But actually, it's put in Knight Swift, it's fine.
Yeah, they're doing fine.
But you do, some of the public ones like Heartland, struggling. A lot of that's due to some of its business units.
Acquisitions.
I think, PAM struggling. And I think those companies are really challenged.
Yeah, the niche, the ones that are overly exposed to certain sectors of the economy tend to have some of the most challenging. Celadon back in the day, obviously very exposed to automotive, really took the brunt of that hit. Well, we're right at the time where we tend to get some Q&A going, so I want to make sure we leave enough time for that. So I'll toss it back over to you, Julia. Let's hear it.
Awesome. Let's do it. I've got a ton of questions. I'm going to go through as many as we have time for. The first question here is from Michael, who asks, how has the trade war command center reflected current pricing on goods and services, despite the conflicts and tariffs going on in Europe and the Middle East?
Well, the Trade War Command Center is a SONAR. I don't know if we can pull it up, but
Yeah,
it's,
you can.
Okay, so the Trade War Command Center, I think the question may be more about the trade war itself, but the Trade War Command Center is SONAR's version of truth of what is on the ground related to trade war elements. One of the cool features is you can look at it on a global basis, but you can also look at it on a regional basis. And this is just a reflection of some of the enhancements we've made with SONAR of trying to give people faster information so they don't have to dig into it. SONAR is a difficult product at times to use because it is so, I think your Wi-Fi connection's not great. SONAR can be a difficult product because it is got so much data in it. One of the really nice things about the command center is it tries to bring everything together. But in terms of the trade war, what's happening, I think the trade war is what we've been talking about all morning or all afternoon. Gosh, it is 2:30. What time is it? 2:43. This is live, by the way.
Yeah.
I'm just, I don't know what time zone it is, time I'm in. But anyways, the trade war itself is obviously has been enormously impactful. And I think what we're starting to see is probably the result of the damage. So it started off with so much chaos. We're no longer in the chaos part of the trade war. We're in sort of we're now living with the repercussions. Now, one thing I'll say, and there's going to be people who emphatically disagree with this, is that we have not seen an strong inflationary bent due to the trade war.
Right.
Now, people say those are because wholesale prices, it takes a while to filter through. There's data that will support that argument.
Absolutely.
But not to the degree, if you think about the fact that I think the average tariff across all parts of the economy are up something like 15, I think before the trade war is like 3% for all the products. I think we're at 18% blended.
Yep.
You're not seeing an 18% impact on goods prices, even wholesale goods prices.
Yeah. And
it's in the 3 to 4%, right? It is filtering through, but this idea that it was going to drive hyperinflation, which is one of the narratives that a lot of the people who are against tariffs are using, was just never truthful. And I think what's actually happened is there's been so much demand destruction due to uncertainty that it's taken so much of the wind out. Now, having the choice between certainty, a certain economy, and a much better output versus what we have right now, I would choose to not have any tariffs and a certain economy. And I was clearly wrong about that. Gosh, this is like a cathartic session here, Zach, where I'm admitting all the things that I've ever said that were wrong. But I clearly was wrong about that. I think, frankly, we need production here, but we also needed an orderly decoupling, and what
not going to happen overnight.
Utter chaos.
Yeah, it's not going to happen overnight. So my take on the Trade War Command Center, if you're looking at, your SONAR, you can clearly see the impact here. What were we talking about? Ocean volume up there in the top left. Demand is down. We showed that to you on the IOTI. Month over month, year over year, week over week. We've got the import volumes down. Intermodal volume is now starting to deteriorate. International loaded containers there in the middle down. And of course, we talked about truckload volume down, but week over week, it's gotten up a little bit, 2%. But it's a little bit more decoupled. If you look at the side here, the top gateways, fascinating trend to me is that Vietnam has actually held up in terms of year over year growth. So we are seeing supply chain adaptation.
I think companies permanently shipped it out of China. And look, a lot of these are Chinese manufacturers. Initially, and I still think a lot of it is just zone skipping, right? They move from one country to the other, to the other. But a lot of it is the Chinese companies, particularly in these lower end markets, not anything, the Chinese government, anything strategic, they don't want going to Vietnam.
Well, what's crazy is that China actually has a lower tariff than Vietnam right now.
The whole, this is just some madness. I'm not gonna, but I think, the reality is the Chinese government, the PRC, does not want its, and this is probably the strongest argument for a national industrial policy.
Right.
And this is where China has the advantage of the United States, is we don't actually have a strong industrial policy. We did during the Cold War because a lot of it was driven by the military industrial complex, but we don't have one and have not had one for many, many years. And I will say this, the reason I supported Donald Trump was because he had an industrial policy. He had an industrial policy that favored national security. Biden had an industrial policy, but it favored decarbonization. And I think it's just a difference. And I support the fact that we need a solid industrial policy. I think what we got is a lot of chaos versus a policy, and that's where a lot of this is happening. But I think what's happened is the Chinese manufacturers moved and opened up shop in China. A lot of it initial was border skipping, still largely is, I think a large percent of it. But a lot of it is also they opened up manufacturing plants, they opened up, because China has its own demographic problems. It has a declining population. And it found that Vietnam was an incredibly great place to build some of the lower end markets, and that's what we're seeing in terms of volume. And at the end of the day, the strategic stuff are not huge drivers of freight.
No.
It's the low end consumer products that tend to drive the predominance of manufactured product volumes.
Yeah.
Next question here has been asked by a couple of folks in the audience. What are you seeing on the reefer market, both for Q4 and early 2026?
I look at reefer market is largely a function of capacity, because the reefer market doesn't have the volume volatility that you see in other markets. You have weather fluctuations that impact reefer, but you don't tend to see the type of stuff that moves through the refrigerated market. Typically are food, medicine, and sometimes you need like semiconductors and other things that have to be temperature controlled. You know, wine is a good example of that, where sometimes parts of the year it has to move through some type of temp controlled. But a lot of times the stuff that's moving through refrigerated is stuff that ends up in consumers' plates and ends up in grocery, it ends up in restaurants, and it's stuff that we eat. And so it tends to be a really from a volume standpoint, tends to be relatively stable. The delta here is that you do see in our data a movement from, like, restaurants tend to buy in bulk.
Yeah.
You have less packaging. In terms of volume, if products going into the restaurant sector versus the grocery sector, you actually tend to have less volume in terms of trucking volume if it's going to the restaurant sector, because they're not buying it for all the packaging. Packaging takes up a lot of space on the truck related to food. Like, you open a box of cookies and you get like 20 cookies in there, and the box is like 30%, you're hauling a lot of air inside that box. And that's pretty true for a lot of these consumer products, where if you're hauling for a grocery product or food product to restaurants, they don't need the packaging. The boxes are bland. It's white boxes with letters that say USDA grade, whatever. It's a box of meat.
I mean, yes, but the refrigerated market itself is heavily connected to the van market. This is something that I talk about a lot with some of our customers, is like, look, this is a pretty fungible capacity. I know that it's not purely, it's not one-to-one, but reefer market is about a fifth of the size of the dry van market. Therefore, it's less well served. So that's why we tend to see higher spot rates, higher rejection rates. And you're looking at a chart of the refrigerated outbound tender rejection rate. The thing that I would say for the refrigerated market coming up, we've got harvest season coming up, and the refrigerated rejections have actually been more volatile this summer versus last summer. We've had a lot of ups and downs, and we tend to see this northwestern harvest season along with the grain harvest and things like that really throw a wrench into things in the fall. And I think I would be, since the current rejection rate, over 13% for the refrigerated market compared to about 5.5%, 6% for the dry van, that's a pretty big spread. Yeah. I think the refrigerated market, much like the dry van, has seen a shed of capacity, and it's going to be more vulnerable.
I think that's exactly it. And the refrigerated market did not have the massive expansion. There's only a finite number of refrigerated trailers, and if you're entering the trucking market, you're entering it, typically entrants into the trucking market that are trying to grow in these sort of bulk expansionary cycles are adding dry van capacity, because the cost of a refrigerator unit can double the cost of more than double the cost of a pine box trailer.
Yeah.
Like it's just the way it works. And so a lot of times these trucking companies that are start up in the van market, and you don't see the boom and bust expansion you see in refrigerated. That's why it tends to be. I mean, look at how stable. I don't know which screen. Let's go back to the reefer outbound tender rejection index that's on Zach's computer, because I think I want to go back and just show this. This is a relatively stable market, is it not, Zach? Like you have some volatility, but it stays within a really tight range. It's a really tight range bound.
Yeah, but at the same time, we've had these like road check week, for instance.
Yep.
Pretty sharp up in road check week, and it came back up again pretty high in early June. But this is anytime we see these like sharp jumps outside of a seasonal trend, like I get a little, and again, this is smaller data set, so a little thinner. So that means it's going to be naturally a little bit more volatile than like our dry van stuff. But this fact it's staying up and it's trending up and to the right overall into a period of time where we actually have seen the last 2 years be a pretty responsive time. I'm watching this one here in about probably a week or two to see where it's at.
Yep.
Next question here is from Derek, who asks, if the proposed merger between Union Pacific and Norfolk Southern goes through, what will be some of the top of mind impacts on trucking as well as the railroad industry?
Like, I'm supportive of the merger. I think it's generally a good thing, largely because it will make traffic across the country more efficient. Like having more efficient, not having to essentially disembark in Chicago and have my freight moved just to go from one railroad to the other just feels a little like a little challenging. I think from that standpoint, from a service standpoint, it could very well improve service. I think the counter argument, which is valid, is that it will not likely result in cheaper costs for shippers. And like, I would love to come back as a shipper magnet, like, or come back and be the son of a shipper, a railroad magnate, and be the son of a railroad tycoon. Like, who wouldn't want to work for the railroads or own a railroad, man? It's a great American robber baron industry.
It's a cash cow.
It is a cash cow. And even today, the railroads are such amazing business models. I've got a book coming out in October. I spent a lot of time talking about the railroads. These are crazy stat from that book is that the railroads made more money in 2023 than Microsoft made. Like some of the BNSF and UP.
Yep.
It is amazing how profitable these businesses are. And mergers and acquisitions are typically not the savings they get, the efficiency they get, don't typically show up in benefits and lower costs for shippers.
No.
But having said that, better service, I do think we can get better service quality. It will probably also trigger more M&A. It's going to be a really interesting thing to watch for. And like as someone who reports on this industry, I'm quite excited about it.
Yeah, I think we'll get 2 mergers out of this. I think that's maybe one of the caveats to the STB, going through the process here. But for trucking, you're seeing it now. Like if you looked at the, I have a chart on loaded container volume versus the OTVI. This is what you get. Long haul volume deterioration goes to the rail now, and this only makes it more of a thing. Now, right now, this is largely happening because service the sense of urgency is just not as strong. And a lot of the flow of freight is moving from west to east. But this right now is, we add another lane. Columbus becomes a little bit more viable now coming from the West Coast versus Chicago. So you get a little further east. You get into Allentown now and Kearney. It's definitely going to take probably a continued chunk from the truckload space on the long haul freight. But we'll see how that manifests in terms of, the service and how that all plays out. That's still a little bit unforeseen. But to me, this market looks a lot like what I would have thought that would have looked like if we had never had this pull forward.
Yeah, I would agree with that.
Great. A lot of folks are asking about outlook for brokerages. So what do you think will happen in Q4 and into next year for freight brokers?
Look, I think freight brokers benefit from really 2 things. One is higher volumes of freight. Look, freight brokers have largely been the winners of the COVID cycle.
Yeah.
and really since 2000, I mean, they have really since the early 2000s, but certainly since the COVID cycle, they got they ended up as a primary primary beneficiary of the massive surge in demand and the fact that they were able to provide a lot of incremental capacity. They actually benefited as well when the market started to collapse because they were able to chase rate down, essentially, and offer shippers cheaper rates. And they ended up becoming primary beneficiaries in the routing guide. And I think despite the predictions that we made and others made about a massive surge and rebound in the market that never came, the thinking was that brokers would, their margins would fall apart significantly because their routing guide participation with these lower rates would end up failing, and that never came to pass. So, and I think now brokers have gotten much better at, they're not being caught off guard anymore, or at all have not been caught off guard, I should say, and have been playing the market appropriately. So I think, this is gonna be really unpopular among our trucker friends. Brokers are gonna continue to be successful. They have probably the best business model of everybody in the space. There will be a lot more consolidation. I think we are seeing a lot of interesting things play out in the freight brokerage, in the entire load matching space. We saw what DAT did. We saw Highways TFS exchange. And by the way, I'll say this because I have been commenting about this trade war, this load matching war. Highway is getting a lot of traction. They're actually doing really well. I've been talking to a lot of major shippers in the last couple of weeks. They're doing quite well. And I think surprisingly, because they're a new entrant, but they're able to build on that fraud moniker. And I think they deserve credit for bringing the story. It's going to be interesting to watch. Again, SONAR is not a participant in this.
Right.
And we're not aligned with any particular party on the whole load matching side. It is, maybe eventually we do end up aligning, but not right now. The interesting thing is sort of watch it from afar. You have this sort of clashing of the up-and-coming company that just raised a lot of money and has a very successful capital raise, is a very successful, arguably one of the greatest and most successful freight tech startups in history. And then you have this sort of behemoth with unlimited resources relative to our industry that is willing to fight it. And then you get everybody else that's sort of figuring out where they go. I just think it's a really interesting time.
I mean, that will
But congratulations to those guys.
Well, we know a lot of people over there at Highway.
Like 70% of the go-to-market used to work at SONAR.
Yeah.
But it's great. I take a lot of pride in the fact that our alumni network is doing well.
Yeah. It's good. Yeah, I think the brokers are here to stay. I think they're actually going to have a decent shot. I mean, they're going to have some challenges probably if the market does have some spontaneous moments here, which I think are likely in the fall. But I think they've largely kind of come through this, and I think they're off the bottom.
Awesome. Well, Zach, looks like that's all of the time we have for today. Special thanks to Aurora for partnering with us on State of Freight today. Craig and Zach, as always, thank you guys for being here, sharing your great insights with us. Be sure to head over to live.freightwaves.com to get your tickets for F3, the Future of Freight Festival. It's taking place right here in Chattanooga, Tennessee on October 21st and 22nd. It is the freight event of the year, and you do not want to miss it. Don't forget to mark your calendars as well for next month's State of Freight. Hope you can join us. It'll be September 18th at 2 p.m. Eastern. Thanks again, everyone.